Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JXR interim report. JXR Fertility Group Limited offers a diverse range of businesses and services, including assisted reproductive services, ARS, in China, and the United States artificial insemination with husband's sperm or donor sperm IVF technology through conventional in vitro fertilization and embryo transfer or IVF with intracytoplasmic sperm injection-related services, plus nutrition guidance plus Chinese medicine treatment, plus psychological counseling medical services, plus obstetrics, gynecology, urology, internal medicine, and pediatrics ancillary medical services hospital-derived services, plus pre-implantation genetic screening testing, plus management consultancy, plus postpartum and rehabilitation care, plus maternal child, nursing property investment, and real estate development and operation activities, sale of medicines, consumables and equipment research and development of IVF, related projects restaurant operations. The recent drop in JXR Reproductive Medicines, JXR, stock price by 9.9% can be attributed to several key factors. The company's interim results for the first half of 2025 showed a significant loss of 1.04 billion yuan, primarily due to goodwill and intangible asset impairment, decreased revenue from institutions in mainland China, and short-term impacts such as changes in medical insurance policies and construction delays. Additionally, the resignation of John G. Wilcox as an executive director and the broader downturn in the Hong Kong pharmaceutical sector also contributed to the decline. Market expectations were not met with a 68% year-on-year decrease in adjusted net profit, further exacerbating the stock's drop. These factors collectively led to JXR's stock price decline. The primary drivers of revenue growth or decline can be identified from the financial summary provided. On the growth side, key contributors include the Chengdu region, with a year-over-year increase of RMB 700 and 67.5 million, overseas operations with an increase of RMB 400 and 5.4 million, and a significant surge in IVF treatment cycles at Wuhan JXR Hospital by 145%. Additionally, revenue growth in Greater China was observed at 15.6%. On the decline side, total revenue decreased by approximately RMB 34.7 million, resulting in a minus 10.7% drop. This decline can be attributed to decreases in IVF treatment cycles, minus 6.1% in Chengdu operations, assisted reproductive services and related services, minus 12.6%, management services, minus 11.9%, and sales of consumables and equipment, minus 31.7%. Net income experienced a significant decline of 68.3% and 32.9%, as per the financial summary. This drastic drop in net income is reflected in the decrease in profit margins across various categories. Gross profit margin plummeted from 40.4% to 30.4%, indicating a substantial reduction in profitability. The net profit margin, which initially stood at 13.2%, took an alarming dip to minus 81%. Although the adjusted net profit margin showed a relatively smaller decrease from 18% to 6.4%, it still signifies a considerable decline. The reasons behind these changes are not explicitly stated in the summary, but they likely stem from various factors such as increased costs, decreased revenue, or inefficient operations. The company's financial performance indicates a positive trend in its operating cash flow. The data from various pages of the report confirms this assertion. Specifically, on page 50, the net cash from operating activities for 2025 is reported to be RMB 267,958, which is a positive figure. Furthermore, page 52 explicitly states that the company's operating cash flow is indeed positive, with an exact amount of RMB234,000. Additionally, although not directly stated on page 63, the accounts receivable component of operating cash flow also suggests a positive trend. Overall, these indicators collectively demonstrate that the company is generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes. The debt level has increased from 30.8% to 33.9%, indicating a rise in the proportion of debt to total assets. Bank borrowings have also seen an increase, with a jump of RMB 97,462 on page 70, and a notable rise from unknown to $75 million, approximately RMB 536 million, on page 71. However, interest expenses have shown mixed trends. On one hand, they decreased from RMB 67.4 million to RMB 49.8 million on page 22, indicating a reduction in the cost of borrowing. On the other hand, there was an increase of plus 42% in interest expenses from 2024 to 2025 on page 54. Additionally, the total borrowing cost decreased by 26% on page 58. Overall, while debt levels have increased, interest expenses have shown both decreases and increases, indicating a complex situation that requires further analysis. The financial performance of the company's segments in 2025 was disappointing compared to the previous year. The Greater China segment and Overseas segment both experienced declines in revenue and profitability. In Greater China, revenue dropped by 13% from RMB 1,137,636 to RMB 985,473, while profit/loss plummeted by 91% from RMB 345,660 to RMB 28,692. The Overseas segment also saw a decline in revenue, down 1% from RMB 306,120 to RMB 303,114, accompanied by an increase in loss of 400% from RMB 87,17 to RMB 43,569. These results indicate that both the Greater China and Overseas segments underperformed in 2025 compared to 2024. Management's outlook: a path to sustainable growth. The company's management has outlined a clear strategy for future growth and development. Key initiatives include expanding its footprint through strategic acquisitions and new property developments, promoting synergies between merged hospitals to enhance competitiveness and reputation, and optimizing products, technologies, services, and management to drive sustainable growth. A key focus area is the reduction of leverage and improvement of liquidity, with a potential shareholders' return program involving share buybacks and dividend policy. The company also aims to establish a replicable operational management system driven by business growth through specialty construction. Geographically, the company plans to expand its business network in China and the U.S., targeting high-growth markets and leveraging favorable industry environments. In China, this involves acquiring hospitals in high-potential markets with swift integration of resources, while in the U.S., it focuses on capitalizing on the growing assisted reproduction market due to relaxed regulations and government encouragement policies. Overall, management strategy is centered around driving sustainable growth through strategic expansion, operational optimization, and geographic diversification. The company has made significant moves through acquisitions and divestitures. Key acquisitions include establishing and acquiring new medical institutions, although specific details are not provided. On the other hand, a notable divestiture is the discontinuation of operations at Jinrui Medical Center in Laos. These strategic decisions aim to shape the company's future growth and presence in the healthcare sector. The company has a history of rewarding its shareholders through various means. In terms of dividend payments, the company has indeed paid dividends, with a final cash dividend of HK 5.95 cents per ordinary share being distributed for the year ended 31 December 2023. Additionally, the company has also engaged in share buybacks, utilizing RMB 12,644 to repurchase shares in 2024. That concludes the financial summary for JXR. Feel free to comment below, and I will be happy to answer them when possible.